All right, welcome to today's Bank Council Roundtable. We are thrilled to be back in person with some in-person attendees. Those of you who are in the room, please feel free to help yourself to food and beverages during the presentation. Our topic today is the commercial real estate market, considerations for banks and affiliates. This content will be relevant for council as well as our non-attorneys who are here in the room and on the phone. So we're really glad to have all of you here today, whether by Zoom or in person. Just a couple of housekeeping notes before we get started. For the in-person attendees, materials and sign-in sheets are available at your tables. For our webinar attendees, materials and sign-in are available to download from the Dorsey login and materials email that you should have received from dorseyu@dorsey.com. We will be announcing a CLE verification code for webinar attendees in states that require a code. Please look for links to the download materials, sign-in, and CLE code in the chat. We will not be doing Q&A today, but of course, please feel free to contact any of us or your trusted Dorsey contact if you have questions. And on the screen, we have a list of states where CLE is expected. All right, I'm going to do some introductions now. This is really fun to have a couple of out-of-town colleagues with us today. I'm Erin Bryan. I'm a partner in the Finance and Restructuring Group in Minneapolis. I co-chair our Consumer Financial Services practice. I also came up doing bankruptcy work and restructuring, so this is a fun crossover topic for me. At the table here with me, immediately to my side is Kathryn Moore. Kate joined the firm recently. She's in our Phoenix office, and we are thrilled to have her here. She represents a broad array of clients, including some of the largest financial institutions, life companies, and regional and specialty debt funds. She helps clients navigate the financing process, but in addition to that, she has considerable transactional workout experience, and clients turn to her for strategic advice regarding faltering and troubled assets and debt restructuring. And then next to Kate is Monica Clark. Monica is a partner in the Minneapolis office of Dorsey. She co-chairs our bankruptcy practice group and regularly represents financial institutions, creditors, unsecured creditors committees, and equipment lessors in local and national bankruptcy cases. And her practice also includes bankruptcy appellate representation. And then last but not least, my colleague, Joe Lynyak. Joe is a partner in our Washington, D.C. and California offices. He's in our financial services practice and focuses on the regulation and operation of financial service intermediaries. He provides counsel on strategic planning, application and licensing, legislative strategy, commercial and consumer lending, examination, supervision, and enforcement, and general corporate matters. So we are thrilled to have such a great panel for you here today. I'll briefly go over our agenda. Today, the goal is to identify legal issues that banks will have to address as the result of the deteriorating commercial real estate market. We will emphasize the steps that legal counsel should consider in the wake of these developments. We will start with the background of the problem, discuss dealing with loan defaults and workout strategies, insolvency and bankruptcy considerations, and then some regulatory issues such as possible bank capital deficiencies and failure scenarios. So we're ending on a light note. All right. Just a little bit of background to set the stage for our presentation, although Kate and Monica will be really leading the discussion today. So many of you have been likely following developments in the commercial real estate market. That may be why you're here with us today. This is increasingly becoming an urgent topic. Recently, the chairman of the Federal Reserve was giving testimony before the Senate Banking, Housing, and Urban Affairs Committee and was asked about the effect of commercial real estate losses on banks, specifically relating to loan defaults, rising vacancies, and similar issues. And he said, yes, bank failures are possible as a result of this. He takes the position that these bank failures would not include systemically important banks and their holding companies, but nonetheless acknowledge that this is a very real and pressing issue. In addition, he addressed the Basel III capital proposal, mentioned that it may need to be modified or reproposed. Joe is going to get in a little bit more to the capital requirements later on in the presentation, but for now, I will just mention that right now the proposal is only affecting the largest 37 banks, including the 8 GSIBs. That could change down the road. It could be expanded to include smaller regional banks, possibly even community banks. That's still an open question. And because CRE loan losses are a rolling problem, banks are likely to be dealing with this for several years, dealing with workouts and other distress situations. There are several reasons for the deterioration in the market. I think it's probably no surprise to anyone at this presentation that the COVID-19 pandemic had a huge effect on this market, particularly with commercial real estate tied to office space. And then there have also been, as loans have needed to be refinanced, the rates have been much higher than the historical rates, and so that's adding pressure as well. In 2023, the federal bank regulators did issue some guidance, really stressing that they want financial institutions to work with their CRE borrowers, presumably because of the concern that overwhelming failures and losses could have a negative effect on the larger economy and the stability of the financial system. It may not be incredibly comforting to banks to have this guidance from the regulators saying, essentially, if you take the right steps to work with borrowers and make sure that they're well positioned to continue the credit on different terms, we won't ding you for that. But of course, this is all against the backdrop of capital requirements, which gets quite complicated very quickly. Similarly, the FDIC updated its longstanding guidance on managing commercial real estate concentrations. One thing that they point out in their guidance is that the commercial real estate failures were a huge factor in the 1980s savings and loan failures, and so most of the folks who are working in this area today were not around at that time, did not experience those losses, may not be familiar with what happened, may be under the misimpression that that kind of large failure could not happen again. And so they really encourage banks at the management and board level to make sure that they have robust risk management processes for their CRE loan portfolios and that they are paying attention to this issue throughout the economic cycle. All right. So how big is this problem? There is approximately $2 trillion of CRE loans maturing over the next 3 years. That is really a stunning amount. Of course, a lot of lenders have been engaging in extend and pretend, trying to keep losses off of the balance sheets, but that is not a permanent solution. It's only temporary. All right, just trying to speed up my remarks here. We do include some additional materials and additional links in the materials to some in-depth analysis that may be useful to you if you are interested in a deeper dive about some of the economic issues at play here. But for now, I'm going to move into the next part of our discussion with Kate Moore, our Dorsey real estate partner in Phoenix, and she will discuss loan defaults and workout alternatives.
Thank you. And just elbow me if I forget to advance the slide.
Sure.
So, well, I'm glad to be here and thank you, Erin. As Erin mentioned, I'm a deal lawyer. So I'm humbled to be up here with my very eloquent and polished colleagues. They don't let me out much, from my desk doing deals under the bright lights and with people. So bear with me, even though even with the help of our wonderful marketing folks, there's only so much they can do with my slide creation here. So what I'm going to talk about is, and I think the information in these slides and this part of the presentation is useful and practical for not only bank counsel. It'll probably be more of a reminder for you guys, but it's really helpful, practical advice for anyone that touches commercial real estate credits. I'm going to start by saying, the old adage, an ounce of prevention, right, is worth a pound of cure. I think that's how it goes. Prevention is the best strategy, right? The best default is no default at all. Obviously, even in a perfect world, if you do everything perfectly, you can't avoid all of the defaults. But what I'm going to talk about are just some very basic reminders about how to make sure that you're well positioned, you maintain proper leverage so that you're in the best spot you can be if and when you ultimately find yourself with distressed credits or distressed assets. And overall, the objectives in any loan, even before you come into a loan workout scenario, your objectives are going to be maximize and streamline your recovery and avoid or mitigate any lender liability claims. So we're going to talk a little bit in the next few slides about how we can do that. So we're going to start kind of at the beginning of the life cycle of a loan. Now, I call it good housekeeping. You can call it good hygiene, whatever you want, but I say good housekeeping gets you good results. Again, there's no magic formula to avoid all problems. But if you follow this basic advice, and if you make sure that this philosophy is utilized throughout your team, your organization, then you're going to find yourself in the best possible scenario, even when all the external factors are out of your control and things go wrong with the loan, because it happens. So I say practice good housekeeping. Start at the beginning. Start when your relationship is still cooperative. If you have good policies, good practices, good procedures, your borrower isn't going to suddenly bristle when you start sending confirmatory emails or setting more formal meetings, things like that. I understand, we all understand that you're in the relationship business. And this is especially, and I think also the counsel out there understands that, we don't want to be impediments to relationships. We don't want to make the bankers, the relationship managers, the portfolio managers, we're not here to make their job difficult. We're here to facilitate the good relationships, and we're here to help them manage and control relationships that are problematic or are becoming toxic, more or less. So communication, and this is a theme you will see throughout my portion of the presentation, good, consistent communication with borrowers, your sponsors, your guarantors, even your team. We'll talk about internal communications a little bit more later, but especially when relationships everything is going swimmingly with your loan, everything's great. And I understand a lot of these relationships are relationships that bankers have built over a long career. They've invested a lot of time and effort into it. And some of these people are your friends. You see them socially. And so it's easy to fall into the habit of, you text somebody, you call somebody, you run into them saying, oh yeah, we're, our accountant has COVID. So we're going to be late on our financials this quarter. And you say, oh yeah, no, that's no problem. No big deal. You get it to us. I know you're good for it. Get it to us when you can. It's easy to fall into those habits when things are good. It's awfully hard to backtrack from that when things start to go south. So it doesn't have to be super formal. It doesn't have to be adversarial or aggressive or obvious even. But I think it's very important to confirm important material conversations in writing. And that's even if it's just like a quick email or even a quick text to say, hey, like we talked about, you're going to need 3 more months for your financial reporting for Q3. I'll run it up the chain, let you know if we get credit approval, that kind of stuff. So that it's not, because those conversations don't look good if you end up in court. Did I do something wrong here?
No, I think you're
Okay.
okay.
All right, good. If you end up in court, so confirm it with an email or a text. Speaking of financials, this is the example I use all the time because it happens all the time. Stay on top of periodic reporting. Again, when things are good, the property's performing, your borrower's crushing it, are you paying attention to whether they're sending in again, we're using financial reports as an example here, but are they delivering those? Are they delivering them in a timely manner? Are they properly prepared? If your loan documents say they're going to be in accordance with GAAP, are they? Is anyone looking at them other than to say, okay, I got this envelope from XYZ Corporation, here it is, throw it in the file. Are covenant compliance certificates completed? Are they completed properly? Are the calculations right? Because you would be shocked when things. Okay,
You're okay.
sorry.
It's just that one.
All right. You'd be shocked when things start to go bad and all of a sudden you're panicking and digging back through, okay, what do I have? Trying to figure out where you are, trying to figure out what shape your borrowers are in. And they've sort of consistently been sending them late or incomplete. And you're suddenly figuring this out. You're suddenly figuring out when there's signs of distress, or maybe even worse, that you're 12 months behind on financials, that they've been calculating their debt service coverage ratio wrong with the wrong inclusions, exclusions, for God knows how long. That's hard to come back from. It's hard to backtrack on that stuff. So if you pay attention to these things and you stay on top of them when things are good, then you can make corrections. You can let them know if they're doing something wrong. When you're all in friendly terms, it is going to make everyone's life a lot easier. And again, by the time these things become critical and you start, frantically pulling out your files, you're going to be dealing with oftentimes dangerously outdated or incomplete information. And then when you start to cross over the line into a distress situation, when there is some signs of stress, don't be afraid to require additional or more frequent financial or other reporting. Most of your loan documents probably have some sort of blanket statement that, in addition to items 1 through 25 that are specifically enumerated here, the lender can ask you for additional reports, financial information from time to time. So don't hesitate. Don't be afraid. If you are needing a more complete picture, get the information. Don't just guess and hope for the best, because that doesn't typically turn out real well. All right, let's see. There it's back. Okay, so speaking of red flags, like financials starting to creep in late, there are certain borrowers, certain sponsors, certain assets, and you all know what I'm talking about. I'm sure you've all seen it, that may require heightened scrutiny. And you may have, the hairs on your neck might stand up a little quicker, and rightfully so, when things start to get dicey. So there's some, I've listed here a few sort of typical red flags we see, and things that I think should be on your radar as well. If, as these annual or periodic reviews come up, the credit reviews, or your triggers, your internal triggers start getting hit. Is this a historically litigious borrower, sponsor, whatever? The only way you might know this, other than sort of anecdotally in the community, is you should be getting at underwriting. And again, this goes back to, good housekeeping, good processes at the outset of the loan are going to serve you well. Get not just UCC searches, not just your title reports, get litigation searches, get BK, tax lien, all that stuff, all those searches. So you can, and it likely will not change your credit decision in the loan origination, but it's going to give you a more holistic set of facts in which to sort of manage this credit and this relationship over time. So that's going to be important information to have in your file, to have to have in your quiver, when things, start to go a little sideways. Is this a borrower? Are these parties that have been, again, maybe since the outset of the loan, reluctant to provide information? And this isn't just, being late on periodic reporting, but were they difficult? Was it like pulling teeth, trying to get financials, trying to get pro formas, anything like that when you were underwriting the loan? Was it hard to get organizational documents, things like that? And again, none of these things in and of itself is a reason that you might, not do a deal, or that a borrower is going to be a bad guy or do bad things. But again, it's giving you a better picture. And just generally, is this borrower, are these people willing to be accountable? Are they willing to say, okay, like we realize we're falling short on some of these things. We're going to make it right. Here's our plan. Here's whatever. Or is it kind of always somebody else's fault? Is it your fault for not being more helpful or giving them more money? And then, of course, every credit is going to be an ad hoc analysis of the facts, but these are just some red flags that you might want to consider, and just be careful about writing off one or more of these red flags or anything else that jumps out to you in dealing with these borrowers as things begin to be troubled. Okay, so back to communications. I touched on this a little bit earlier, but your communications with the borrower, with the sponsors, with your guarantors, with your principals, be clear and be consistent. The hey buddy, yeah, we'll get that done, no problem, text, thumbs up. Like, that's not clear. That's not consistent. That's not going to look good when a judge is flipping through 100 pages of your text messages, God forbid. So that's why, again, these recap emails, when we're talking about material terms, waiving defaults, extending deadlines for things, don't be afraid to do that. And if you start early and often, it's not going to seem weird. It's not going to get, a borrower's hackles up. And this next item, this may be more relevant for when you are having tense conversations, when things are, when you're starting to have conversations heading towards a workout or considering some sort of accommodations, forbearance, et cetera. Bring a colleague with you. It doesn't necessarily have to be, counsel or whoever, but at least you've got someone that can corroborate the conversation. And it's not necessarily just, he said, she said, she said. And then, of course, and I know I'm not telling you all anything you don't know, but don't forget the importance of reservation of rights letters or even formal default notices, even if you don't plan to enforce. But if any of you called me up and said, hey, they are missing their, happens all the time, they're going to miss their completion deadline, they just need another month, should we do anything? And yes, absolutely, send it. You could do it yourself or have me do it. It won't hardly cost anything. And it will create and preserve a really good record for you. And it will establish this thread of clear, consistent communication. Because what you're saying is, okay, you've asked us for an accommodation where, we're either granting it or we're saying, hey, we know this has happened. You have failed to satisfy whatever covenant. And we all acknowledge and agree, and it's here in writing that this has happened. And just because we're not doing anything right now doesn't mean we're waiving our rights. So you shouldn't assume that because we're not doing something now, that we didn't do something in the past, or that we don't do something in the future. You shouldn't assume that means that's the way it's always going to be, or that we're waiving these rights. I'm sure you see it too. You see these things all the time in real life, even when people are doing everything right. Not just a few months ago, we had a situation where it was not even necessarily an underperforming credit, but they had needed in this capital markets environment, they had needed more time to refi it, but frankly, just weren't that motivated. They had a pretty good interest rate, and it was always in the works, right? So the lender had consistently extended the maturity date at the borrower's request, 3, 6, 9, 12 months, whatever. And, finally they came back and asked for another, I think, 12-month extension. And, per standard procedure, which had been done every time, ran it up through the, credit, and credit said, no, it's time to go. It's time to pay this off, and they need to be motivated to refinance it, right? And they've done everything right. This was at least 120 days before the scheduled maturity date. All the record was good, reservation of rights letters, et cetera, et cetera. But they still, said, hey, listen, no, we ran up your credit as you asked. They said no. So, the loan matures in 120 days, and we expect you to be prepared to do that, to refi or pay us off in some other manner. And, you get it, and this again had been a heretofore friendly, collaborative relationship with the borrower, and you get a 10-page nastygram letter back asserting lender liability, course of dealing, all these things. So they're like, you have been doing this for a year, for 2 years. Of course, we expected you to renew it again. Why wouldn't we? And we forewent all of these opportunities, and we could have done these other things in reliance on your past actions. Now, of course, that's not, it's not going to stand up, but put yourself in a good position to foreclose any of those types of arguments, or at least be in a good position if, God forbid, you end up in litigation to achieve summary judgment. Now, this is a reminder. This is obvious, but I'm going to say it because it bears repeating. Resist the urge to vent to your colleagues, and make it clear to your team, to the people that report to you, or the people, the teams for whom you're responsible to support, that resist the urge to vent to each other about borrowers, of making personal attacks. I mean, we all want to do it. I understand how frustrating it can be. We've all been there, but I think we're all smart enough not to probably send work emails, but I'm talking about Slack, Teams, Jabber, text messages on your work phones. If you are getting work emails on that is all discoverable. So I want you to imagine the next time you're about to hit send on some curse-laden, emoji-laden text about a difficult borrower, I want you to imagine yourself reading that text out loud in court with all your colleagues there and a judge, and then maybe just send that to your drafts file. So resist that urge. And again, it doesn't necessarily go to the facts of the matter, right? It doesn't mean that you were doing anything to disadvantage the borrower, or there's any bad faith involved, but it really doesn't look good, and it tends to create questions of fact for a judge, and it's just one more complication that's going to hamper your goal of streamlining recovery and streamlining any sort of disputes. And then just a note, I know most people here as counsel, you understand this, but I still see it a lot. And I hesitate to be pedantic about it, but remind your teams and the folks that you support that they should not be forwarding emails from counsel. That means you guys, that means us, outside, to the borrower. Because sometimes, they'll say, borrower wants this, what do you think? And I say, okay, XYZ. And I see that they've just forwarded it out. Don't do that for a million different reasons, not the least of which being, of course, you're waiving your privilege. So that's just a reminder and something that you could, remind your folks. I'm going to speed up. Sorry. All right. Due diligence, real quick, not just for loan origination. When things start to look troubled, when things start to look dicey, don't hesitate to engage in comprehensive file reviews. Pull out all the loan documents. Make sure you've got what you think you've got. You will be shocked what you might find. Some common things we've seen. You get documents completely missing, documents that aren't signed, security interests that haven't been properly perfected, your legal descriptions are wrong. Did you ever get a title policy? Third-party consents you didn't get. This is really crucial, especially if you haven't, touched the credit in a while, if it's been sort of dormant, because otherwise you have no idea what your leverage is, or, what your exposure is when you're going into workout negotiations. So this is important, and it's time well spent. Also, to the extent, any of you are dealing with syndicated or club deals, make sure you understand what your rights and obligations are as a in your different roles. So if you know you're the lead agent, make sure you understand what you can do and what you must do. If you're a co-lender, understand what you can make the agent do and understand what you can stop them from doing. And if you're a participant, I mean, it varies greatly. If you're a silent participant, you should understand at least what kind of notices you're getting and what sort of ability you might have to get out. If you, to the extent you don't have control, which you often will not have. And a word of caution also, we won't get into state by state stuff, but be careful about if you've got co-lenders in your deal that have accounts, deposit accounts, be careful about rights of set off. Make sure that nobody is setting off without everybody consenting to it, because we've got states where, that's a one action rule and then you're toast if somebody does that without everybody else knowing. So just some things some pitfalls to keep in mind there. And then site visits. Get out there, see the property. Even if it's a plane ride, is this property operating? Is it open? Are there tenants? Is the lawn being mowed? You'd be shocked what you can discover just by taking a trip out to the property. So, all right. And then lender liability. Again, this is probably a refresher for everybody, but what is lender liability? Lender liability is a separate claim from, just a loss on your credit. And this can be over and above the loss on your credit. This exposes you to more claims and more damages than just the loss of what you've loaned. Some common claims are by the borrower. The lender was exerting excessive control over our business, and we did what they made us do, and now we've experienced all these losses because of what they told us to do. What is that? So, you go to a bar and say, you must divest this asset. You must use a certain accountant, things like that. Don't do that. I think that's a reminder, but you can say you need to get an accountant, pick one, but you need to have somebody look at your books. So just be wary of how much control and direction you're exerting over their business. Obviously, the breach of the covenant of good faith and fair dealing, that's a very common one. That's kind of the catch-all for anything a borrower doesn't like that you've done. And then the course of dealing that we talked about it. And you can set yourself up well to avoid those if you're doing consistently reservation of rights letters and documenting your file. Of course, there's no sort of magic bullet or I guess magic shield would be a more appropriate term, to protect yourself from these. Because again, these are the things that borrowers will throw at the wall, see what sticks, but set yourself up. And then again, how do we minimize this? Get releases when you're doing amendments, forbearance agreements, et cetera. You're giving them something, get something in return. These are useful, valuable, and enforceable. Comply with the terms of the loan documents. It sounds obvious, but it's more or less a safe harbor. Just do what the loan documents say. Don't exert excessive control, blah, blah, blah. And again, make sure that they understand if you're in preliminary discussions that there's no binding agreement and they shouldn't rely on the discussions until something's in writing and everyone signed it. And real quick, another question I get a lot is, okay, well, what do, we got this default, what do we do? Should we just amend the loan documents? Should we forbear or should we just enforce? And, we can't necessarily answer that. Obviously, it's so much of it's a credit decision, but, and there's no one size fits all solution, but some things you will want to consider when making that decision, when evaluating the credit. How likely is it that this project, this property, this asset can perform or refinance in the long run? Think about that and think about, is it better to just pull the plug now, or can we get this to a place where it's no longer limping along? What recourse do you have against your guarantors? What sort of tools do you have to put pressure on them? What are their pain points? Do you have a carry guarantee? Do you have a completion guarantee? Is this project, is this loan part of a larger relationship that's important to your institution that you need to make certain accommodations for? Can you extract some leverage, some additional credit enhancement as a result of that? And how short of a leash do you need to keep this borrower on? That's a forbearance can be a useful tool for this because you can, more or less pull the plug. I won't go through all of these next couple of slides. They're pretty much just saying the same thing in more detail about, considerations for an amendment. I provided some examples here. For an amendment, I think, can you make amendments to the loan terms that don't compromise the credit integrity and will accommodate the borrower's needs and performance? And it's reasonably attainable. Have they shown you something, some credible projections that say, yes, like we can perform in the long run with this one tweak that will not destabilize it from a credit basis. And the forbearance agreement, this is more appropriate where a borrower's ability to come back into compliance with the original loan terms is maybe less certain. There's some systemic issues or there's some external issues, or this is a serially defaulting loan where, we're not sure if this tweak is going to work. Let's give it 6 months. Let's give it 30 days, whatever. And then enforcement. Again, this is, there's too many sort of examples here to go through altogether, but, you've got you may have a guarantee. Make sure you've considered exactly what the pain points for the borrower there or the guarantor there are, what pressure you can put on them. Is it non-recourse? Is there a carry? Is it completion, payment, whatever. Receiver, again, state by state, but this is an option and it's especially useful for specialty asset types like hospitals, hotels, things like that, maybe you really need to make sure if they're being mismanaged, they get into the right hands. The deed in lieu, this is for, in states where you've got a long foreclosure process. And then, there's obviously some state by state considerations and it's only appropriate where title's clean. And then foreclosure, which everybody is familiar with. So, I think that is it. And I'm sorry, I went through the last slides as quickly as I could, but big picture, my set of the slides is if you have good housekeeping, if you have good practices, policies, and you have your team and your group on board, can't avoid all defaults, but you will be in the best position to handle them and have the best leverage going forward.
Thank you, Kate. That was really excellent. We're going to move to Monica Clark next.
You want me to click, Erin, or you
Sure.
gonna click through? No one should ever put me in control of the clicker, but I'm gonna try to do my best. So all of your suggestions and tips, Kathryn, were wonderful, but they ratcheted up my anxiety as a bankruptcy lawyer. By the time a file comes to me, all the bad stuff has either really happened or is just really beginning. So I'm going to talk mostly about what I am seeing as a bankruptcy lawyer when it comes to CRE issues. My notes say it's an exciting time, but it's actually kind of a frustrating time to be a bankruptcy lawyer, frankly. So why are we here? I think we know why we're here. And in fact, Erin, you touched on that a little bit. The pandemic fundamentally has changed how people live and work. I'm going to give an anecdote. So interestingly enough, I was a juror in a criminal trial here in Hennepin County about 10 days ago. And I got to talk to all of my fellow jurors, and I was the only one who is still coming into the office and working in downtown Minneapolis, and actually talking to my fellow jurors about where they could park. People who are in all kinds of different industries, they just haven't gone back to the office for whatever reason. So employers are needing to downsize, make decisions about downsizing space. Some are obviously going fully remote, and that has affected office space vacancies, which are at historic highs. In conjunction with that, consumer preferences have changed. Certainly most folks were doing a lot of online shopping before the pandemic. It just seems to be what everybody is doing these days. I have a 19-year-old daughter who I offer to take shopping all the time. She doesn't ever want to go with me, even when I offered to pay. That just is not what the younger generation is doing. And both of these factors have contributed to store closures and retail bankruptcies. I want to start a little bit with statistics. And Erin, I think you mentioned some of these numbers. So if the Mortgage Bankers Association is to be believed, there are 4.7 trillion in outstanding CRE loans. 2.2 trillion of this amount will come due in 2027. Approximately 529 billion of commercial mortgages will mature in 2024, with just a modest increase in 2025. And, I first was thinking that I would describe these numbers as alarming, but in actuality, they're really sobering. Especially because small and mid-sized banks underwrite many of these loans and will have exposure. So I want to give some examples. It seems like you can't turn around these days without a retailer filing bankruptcy. And at the time that I prepared these slides, Red Lobster had not filed. I went on vacation, came back and read about Red Lobster, and I was very depressed. There have been 30 retailers in 2023 that have filed, and I'm kind of mentally going through the mall down the road and thinking about all the retailers that are gone. David's Bridal, Serta, Tuesday Morning, Bed Bath & Beyond. Party City makes me sad. I spent a lot of time in Party City when I had a little kid who did parties and wanted helium balloons. In 2023, the shared office space provider WeWork, we've all heard about that, filed its bankruptcy case. 3,200 retail stores have closed in 2024 alone, which represents almost a 25% increase from last year. A few more examples, and the store numbers in parentheses may or may not be accurate because as a bankruptcy case evolves, more stores necessarily close. Family Dollar, 620 stores is a lot of stores. Rue 21, CVS, 7-Eleven, Rite Aid. We're working in Rite Aid, we're working in the Express case. So again, so far in 2024, Body Shop, Joanne, 99 cents only, which I didn't know about. We have the dollar store here. Express, Rue 21, apparently its third bankruptcy filing. And again, Red Lobster. So on a positive note, because we are all about positivity on this panel, not all CRE has been affected as much as office and retail space, industrial properties, and hotels purportedly are doing well, which is logical because now folks are sort of getting out and they're feeling more comfortable traveling and vacationing and they're going to hotels. I'm going to talk a little bit about what I am seeing and how CRE issues emerge in bankruptcy cases. So they can arise in a variety of ways, but the most typical way that a CRE issue appears in a bankruptcy case is when a tenant under a commercial real estate lease is trying to do something with that lease in bankruptcy. Bankruptcy is a tremendous forum for affecting leases because debtors have almost unfettered freedom to decide what they want to do with their leases. They can assume them, which is a fancy way of saying they can keep them or retain them. They can reject them, which is just a way to say they're going to cast aside an executory contract or a lease. They're going to get rid of it. And they can also assume and assign those leases to third parties. So bankruptcy, for all of those who know, is it's a strange statute. Lots of weird words in bankruptcy. So I try not to use them when I'm presenting, but sometimes we have to because they come up. So commercial real estate leases are described as unexpired leases of non-residential real property. That's not that strange. It's kind of intuitive. CRE leases play a significant role in a retailer's bankruptcy case. And in fact, they often drive retail bankruptcies when debtor tenants are deciding what to do with many leases that may be unfavorable. It's a great place to exit leases, to shed leases, or even to renegotiate leases. When a debtor files a bankruptcy case as a tenant, its leases become part of the bankruptcy estate, its leasehold rights. And the bankruptcy code again permits a debtor to assume, reject, or assume and assign leases. And I've got the statutory reference, which nobody cares about on this slide. So there is a time period for debtors to assume or reject leases. Commercial real estate leases are treated differently than other leases. There's a longer period for other leases, but a debtor must decide what it wants to do with its leases within 120 days after it files its bankruptcy case. It is not unusual for a debtor, especially a retail debtor, with literally hundreds and hundreds of store locations, so hundreds and hundreds of leases, to ask the bankruptcy court for an additional 90-day extension. It's practically always granted because, again, it would be very hard for a debtor to review hundreds and hundreds of leases in a 3-month period. So extensions can even go longer than that, but they would require landlord's consent. And although this rarely happens, it's worth mentioning that if for whatever reason a debtor overlooks a lease or just decides not to do something with a lease, that lease is automatically rejected. It's deemed rejected, and the property has to be surrendered to the landlord. So what happens during this interim period that I just described as a debtor is figuring out what it wants to do with a certain lease? Well, if the bankruptcy code works the way it should, and you're going to kind of hear my cynicism here, a debtor must timely perform all of its obligations that arise under its commercial real estate leases. We've included the statutory language on the slide. But despite this requirement, this is what I am seeing as a bankruptcy lawyer who represents landlords in retail cases. Because debtors have the ability to reject leases, it is not uncommon for debtors to utilize or wield that leverage and to skip post-petition payments. So we have had clients in WeWork, we've had clients in Express, we have had clients who have not been paid their post-bankruptcy amounts, and we have taken appropriate steps in bankruptcy to get those amounts paid. In response to those actions, we have had debtors threaten to reject our leases. We have had debtors describe our landlord clients as not being good partners. This is what I would describe as a concerning trend in retail bankruptcy cases. Again, landlords are entitled under the bankruptcy code to be paid for rent. So I want to talk just briefly about stub rent. It is an issue that comes up frequently because commercial real estate leases frequently require tenants to pay rent in advance, and that rent payment is typically due at the start of each month. So that can create kind of a strange situation in a bankruptcy case because it is, you might have a debtor, for example, with a rent payment. I said as an example on June 1st, the debtor might file a bankruptcy case on June 3rd or June 4th. What happens to that rent for the balance of the month? Well, it depends on where the bankruptcy case is filed. And I'm not going to bore everybody with talking about the various approaches that courts take. There are two main approaches. But I will say that landlords can recover rent in most jurisdictions, not only under 365 that you've seen on your screen, but under other provisions of the bankruptcy code, including a provision that entitles a landlord to an administrative claim. So let's go back to assumption. And again, as a reminder, assumption is when a debtor tenant decides that they want to keep a particular lease because it's favorable to them. If a debtor decides that they want to keep a lease or a group of leases, they have to do some very specific things under the bankruptcy code. This is where the weird bankruptcy phraseology comes into play. A debtor must cure, which just is another word of saying pay, all pre and post bankruptcy amounts that are owed to a landlord and to provide adequate assurance of a debtor's ability to perform in the future. But as noted above, because debtors can reject all of their leases, it is very commonplace for debtors to negotiate cure amounts, sometimes to require landlords to waive everything that might be owed pre-bankruptcy and post-bankruptcy, or even materially alter the terms of their leases. Debtors have considerable leverage under the bankruptcy code. Okay, talked also about retail cases. Very common in retail cases these days for debtors to assume their leases and to assign them to third parties. This might be a third party that's interested in buying all of a debtor's assets, the going concern of a business, or a buyer that's interested in particular locations. Happens all the time, and it happens very quickly in bankruptcy cases. What we are seeing in filings, debtors will very quickly file a list of the stores that they want to reject, file a list of the stores that they want to assume. So if you are a client with an interest in store locations, you have to watch bankruptcy cases very carefully. Retain a lawyer if you're not comfortable doing that kind of review yourself. The other thing that kind of irks me as a bankruptcy lawyer, and I know there are some of you in the room that have had experience with this, but when debtors reject leases, they frequently conduct store closings at those lease locations. It is a circus, to be honest. All of these store closings in practically every instance will violate many, many terms in commercial real estate leases. And it will make not a whit's bit of difference to the bankruptcy court when that happens. It will make a big difference to a landlord who is surprised that they have people pasting signs on the outside of a building or people walking in front and advertising and going out of business sale. But bankruptcy courts allow this, rightly or wrongly, and mostly based on theories of preemption that we won't get into today. But if you're a landlord, don't be surprised when that happens. Let's talk a little bit about the consequences. Again, assumption and assignment of commercial real estate leases, incredibly favorable for the debtor, incredibly favorable for a buyer, much less favorable for a landlord who often is surprised to find that they are doing business with a new tenant. And it may be a new tenant that has a very different financial picture and ability to make lease payments. I've had many landlord clients say to me, well, wait a second, I've got a lease that contains anti-assignment provisions, to which I unfortunately have to say, well, that's terrific outside of bankruptcy. But in bankruptcy, those lease provisions are almost anti-assignment lease provisions almost always will be overridden by the bankruptcy code, frustrating for landlords. And landlords that don't pay attention to the cure amounts that I just mentioned and object to them if they are inappropriate, will be stuck with them forever and ever and will have no recourse from the new buyer. I'm trying to go quickly, Dr. Doom, so that you have some time to speak. Okay, so landlords have a little bit more of an advantage when there is a shopping center situation. I'm going to spend no time on this other than to say that Congress was wise in recognizing that shopping centers present completely different issues. Some issues, tenant mix and radius considerations. Everything is different when you've got a shopping center involved because the dominoes really start to fall when certain anchor tenants are gone in shopping centers. So statutory language, I'm not going to read it. It's boring, but it's there if anybody wants to see it. Want to talk quickly about what happens when a lease is rejected. All of you will have that experience. You'll have an interest in a lease and that lease gets rejected. Nobody likes rejection because that gives rise to a general unsecured claim, which is practically worthless in most bankruptcy cases. Trying to be positive again, I will say that if you are a landlord whose lease gets rejected, but your lease space has been used at least for some portion during a bankruptcy case, you ought to have the protections of an administrative expense claim. But sadly, so many of our bankruptcy cases these days are administratively insolvent, and the claim is not going to be worth 100 cents on the dollar. Okay, one last slide. Dr. Doom asked me about receiverships, and we actually have some receiver clients sitting in the audience. And Kathryn, you touched on it briefly. There are federal receiverships too, but it is principally a state court legal remedy that enables a party, mostly a secured lender, to place an asset or a business into the hands of a court-appointed agent called the receiver, sometimes described as a state court's version of a bankruptcy proceeding, and there are quite a few similarities. Receiverships, state court receiverships, obviously, are governed by state laws. State laws are not uniform. State laws are usually fairly sparse, at least by comparison to the bankruptcy code. Receiverships permitted by almost every commercial deed of trust. They are commenced by the filing of a complaint, and usually in conjunction with that, there's a motion where the secured lender seeks to have a receiver appointed. So they result in the placement of a borrower's property in the hands of a receiver. That property may obviously include real estate and leases. Generally, but not always, are less expensive, less frustrating, more efficient than a bankruptcy proceeding because there are far fewer hearings and things to file. And they accomplish many of the same objectives that you can accomplish in a bankruptcy through a bankruptcy sale, including sales which are free and clear of most, but not all liens and the assumption and assignment of leases. Dr. Doom, go. Okay.
Oh, hi, everybody. I just want to talk a little bit about the other side. Oops, I'm going the wrong way. The other side of loan workouts and receiverships, et cetera, which is the bank may be going under. as you see here, this is my alter ego, Dr. Doom. I originated in 1962 in a comic book known as the Fantastic Four. And actually, I think it's an allegory, the Fantastic Four, for the federal banking agencies. They bring me in when things are going wrong and we have to start worrying about it. But we don't have time to talk about the accounting rules. And God forbid you want to ask me about accounting. But just bear in mind that as losses are recognized, GAAP and regulatory accounting means that you've got a reduction in your capital accounts, at which point you can end up with real serious difficulties in terms of turning around the bank's balance sheet. We may be at that point for a lot of smaller and medium-sized banks because it's a general recognition that people have been deferring losses for a period of time. And some observers think that now the government will be demanding that there be recognition, which again hits the capital accounts. It also affects disclosures in terms of the SEC disclosures and also your shareholders. And so again, you're at that point where something is beginning to go wrong and things need to be changed. A couple of things to just be aware of, and a lot of people don't know this, and this is, I'm always confused because under the International Lending Supervision Act, going back about 2 decades, the banking regulators were given the right to set capital levels for any bank at any level they want. And they very rarely utilize that authority, but it's always been sitting there. An important point in that they can give you a capital directive saying, we want 50% capital, have a nice day. But the 400-pound gorilla, which really begins the deterioration of a bank's safe and sound operation, is the prompt corrective action authority under Section 38 of the FDIC Act. And what it does is it lays out levels of capital below which, on an accelerating basis, the FDIC or the other banking regulators are able to effectively shut down the operations of the bank. And you have well-capitalized level, adequately capitalized, undercapitalized, substantially undercapitalized, critically undercapitalized, and so forth. But one of the things that happens is they lock down the bank's operations and on a regular basis. And one of the things that a lot of people don't understand is that you may be well-capitalized, but then they can move you down to the adequately capitalized level and start doing it even to a well-capitalized bank. They don't do it often, but they do it when they think that there really are losses which are going to bring this bank to its knees. And again, that's when real care has got to be exercised. And you can see here some of the things they can do to shut down a bank. It's a terrible time for the bank management and for the board of directors. And some of the things that are really necessary to look at when these things occur is that all of a sudden you get a telephone call saying, do I have individual liability because I'm a member of senior management of the board? And the answer is, oh, you sure do. And what do you need to do? Well, you got to begin to review your documents and figure out what your documents say and whether or not you've taken adequate steps to document what you have done that's prudent. You need to assemble assemble a team. You need a team. You can't use a collection attorney to help you in this regard. You got to use counsel. You got to also have an internal team to be looking at these issues. You got to look at corporate law formalities. What does corporate law require? For example, I'll refer to you to the Atherton decision, the Supreme Court decision, setting the standard for reasonable conduct by board members. Very important decision. And what does your state law say? You've got to make sure you state the prudent steps you've taken in writing, because if it's not in writing, it does not count. Your record retention policy, and I think we've mentioned several times, you've got to have a lecture with people about emails. The CFPB has brought to new heights the use of emails and grabbing them and reading some really silly comments. They can't be silly. They got to be serious, and they've got to be directed in a manner that's prudent to represent what you're doing. And probably the most important thing you can do, you've got to call your D&O carrier and find out what is covered. In many states, D&O carriers do not have to cover claims by the government, and that can be the kiss of death, particularly if you potentially are a target. Just as we have now gone through this stuff very, very quickly. But there are 3 articles that we reference at the back of this deck, which were written over a period of time, actually 2 cycles of bank failures, which give you a broader idea of what needs to be done, how it needs to be done, and what some of the compliance issues are that need to be faced. And we hope that that is helpful to you. And I'll turn it back to Erin. Thank you very much for your time and this quick rundown.
Great. Thank you so much. This was really informative. If you need credit for attending this presentation, please make sure to send your completed sign-in to attendance@dorsey.com. For those of you on the webinar, if you're in the room, just sign in at the table. Certificates will be sent only to those who complete the form and return it. And if you have questions, please feel free to follow up with any of the panelists or your Dorsey contacts. And again, the materials and sign-in are available for download from the email that you should have received from events@dorsey.com, but let us know if you didn't get it. We are taking a break for summer vacation, but we will be back in the fall with our next Bank Council Roundtable, and we're really happy to see folks back in person in the room. Hopefully this will be able to continue. So thank you.